Recently, many economists predicted that a recession was imminent and that inflation would take years to decrease. However, it seems the situation has changed and the U.S. economy is now showing signs of resilience rather than a recession. If you are new to the channel, please make sure to subscribe and leave a like below. We would greatly appreciate it. In contrast to the usual slowdown in hiring prior to a recession, employers have added a significant number of jobs in the last month. The unemployment rate, which typically increases during economic decline, has dropped to its lowest point since 1969 at 3.4%. Additionally, inflation has been decreasing and currently stands at 6.5%, down from its high of 9.1% last year. So what's happening? While recessions are a regular feature of economic history, warnings of imminent trouble are looking exaggerated. Digging a little deeper, here are some of the questions economists and government policymakers are wrestling with. The question remains whether or not the economy is heading towards a recession. Despite high prices and announcements of layoffs by large companies, especially in the tech industry, the increase in job losses has been largely balanced out. It's important to note that a recession cannot occur without an increase in unemployment. A recession is defined as 2 consecutive quarters of negative growth in the overall economy. As long as employers continue to hire workers, the economy will continue to grow as more people have jobs and money to spend. In 2022, the economy added an average of 400,000 new jobs per month, and hiring was even stronger at the start of 2023 with employers from various industries, adding 517,000 jobs in January. Additionally, the number of job openings has doubled from a few years ago to over 11 million, according to the Labor Department. The growth in jobs is mainly driven by consumer spending, which is the biggest contributor to the U.S. economy. During the pandemic's peak, people chose to stay home and spent their money on items that made being at home more comfortable. However, this trend has since reversed. While there are still some challenges in the economy, such as a decline in manufacturing and housing that are sensitive to interest rates, overall consumer demand continues to grow, leading many businesses to increase their operations. It is also believed that any potential near-term recession would be short and mild, which is why businesses are not drastically cutting back. The fate of the economy is not solely dependent on consumer spending. Employers have other reasons for avoiding significant cutbacks, such as a shortage of workers in the U.S., which has been eased by increased immigration during the Biden administration, although skilled workers are still in high demand. Many employers who laid off workers during the pandemic have also realized that it's challenging to reassemble teams. In the technology sector, companies such as Microsoft, Amazon, Meta, Google, IBM, Dell, Cisco, and Twitter have announced significant layoffs, which is a result of the cutbacks after years of expansion and, in some cases, overexpansion. Despite the tight job market and inflation, wages have not increased as much as expected. Economic theory suggests that wages should be rising as employers compete for a limited pool of available workers, with currently about 2 job openings for every unemployed worker. However, the average hourly wage for all private sector workers increased by only 4.4% in January compared to the previous year, which is a decrease from previous months when the earnings were growing at an annual rate of more than 5%. This situation creates a schizophrenic job market where job growth is booming but wage growth is slowing down, as noted by Harry Holzer, a Georgetown University professor and former chief economist at the Labor Department. There may be various explanations as to why wage growth is cooling despite a strong job market, one expert theorized. Perhaps workers are spending their savings and are more concerned with job security instead of demanding higher pay. Additionally, with inflation dropping, workers might feel less urgency to ask for pay raises. There is also evidence of fewer workers quitting their jobs compared to 2021 and the first half of the previous year. People usually receive bigger pay increases when they change jobs. Moreover, businesses are now hiring individuals who have traditionally been excluded from the job market, such as people with disabilities or criminal records, which could be causing the moderating wage inflation. This expansion of the applicant pool means that businesses do not have to offer as much pay to attract workers, which contributes to the gap between job seekers and job openings.